So you want to learn about stock options? Stay with me. I'll teach you everything you need to know. To put it simply, options are just a form of investment that can be bought and sold in the same way that you can buy and sell stocks. Options are referred to as derivatives because they derive their value from an underlying security. They also get their value from sources such as time, volatility, and intrinsic value. What I mean by that is that the price of a stock is what actually determines the price of a stock option. There are only two types of options that exist: calls and puts. And it's really as simple as that. Options are a direct investment, and anything that you would want to achieve on an investment basis can be realized using options as well. Options are extremely appealing as they offer a much greater return than stocks. However, that does come at great risk. Here we have the chart for Apple stock. On the right we have the chart for the Apple 150 January 18 calls. I'll make a separate video explaining more about expiration dates, strike prices, and so on and so forth. But for now, let's just compare Apple stock with Apple call options. On the date of 12/26 at 11:30 in the morning, Apple was trading at 148.96. On 12/31, Apple was trading at a high of 159.36. Assuming that we bought here and sold at the high, which we wouldn't have, but let's just assume that we would have, 159.36, we'll be able to determine our possible gain. 148.96, we'll subtract 148.96 from the high. And so if we had purchased here and sold literally at the very top, we would have made $10.04 per share. So to figure out what that return actually would be, we would divide the return by the entry price of 148.96 and then multiply this by 100, and that would give us a percentage return of 6.98% from 12/26 to 12/31. Now let's look at what the call option would have returned during the exact same period of time. 12/26, we could have purchased this call option at $7.41, and on the same day, on 12/31, it reached a high of 11.70. Now remember, the stock return was 6.98%. So let's figure out, if we had purchased the option, what the return would have been for the same exact period of time. We'll take the high price of 11.70. And we'll subtract the entry price at the very same time that we said we would have entered Apple stock. We'll take the closing price of $7.41. And that gives us a difference of $4.29. Divide that by the entry price of $7.41. Now multiply by 100. We get a return of 57.89%. So we could have purchased Apple stock and made 6.98%, or during the very same period of time we could have purchased the Apple call option and made 57.89% on the very same move in the Apple stock. Remember, options derive their value from stocks. So when you purchase an option, what you are actually purchasing is the contractual right to buy or sell the underlying security or commodity at a specific price by a specific date. That's why the option price is derived from movements in the stock price. If you'll notice, you'll see similar highs here and here, waking up here and here, that the charts look very, very similar. Inversely, when you sell an option, you're selling the contractual right to buy or sell an underlying security at a specific price and by a specific date. It's very, very important to remember that all options are bought and sold in contracts. Let's take a look at a little bit of option chains. Here we have an options chain for Apple stock. Today is January 19th, 2019, so we will only be able to see options that expire in the future. Here are the listed option expiration dates, and this column shows how many days until expiration. It's really important, as I said previously, that all options are bought and sold in contracts. So what does that mean? Option contracts are most commonly bought and sold in 100 share contracts. So if we look at a strike price, let's just say for Apple, and we look at the 150 strike price, we see a price here, an ask. Remember, we always pay the ask and we sell for the bid price. You pay the ask price and sell for the bid price. If we look at the strike price of $150, we see a price of $390. So that price of $390 represents one option. However, because we buy in contracts, we will have to multiply this number by 100 to see what the order actually costs. $390 times 100 will be $390. So if we were to buy one options contract for Apple, here, looking at the calls, it would be $390. Alright? If we went to January 18th expiration, the same $150 call would be $5.15. Multiplied by 100 would be $515 per contract. We can buy as many contracts as we would like. So it's always important to remember these are sold in contracts. Options are also typically listed by month, with monthly options expiring on the third Friday of that month. Here, these light colored horizontal cells show options that are expiring by month. Apple has options that are listed monthly: January 18th, February 15th, March 15th, April 18th, June 21st, so on and so forth. For some companies that are very, very liquid, there are options that actually expire weekly, and that's what we're seeing here with Apple. Here we have a weekly option that expires on the 11th, which is a Friday. And then we would have the 25th, which would be a Friday, and February 1st is another weekly option, and the 8th, and so on and so forth. We can look at and have the right to purchase any expiration that we want, but it's very important to remember that when the expiration date arrives, if the option has not been exercised or sold in the same way that you can sell a stock, it will expire completely worthless. Let me emphasize that one more time. If you are still holding this options contract, this one in particular, let's choose January 18th of 2019. Let's assume I bought the 150 call for $515 per contract. Let's say it appreciated to $700 or $715 so that I had $200 profit per contract. At 4 o'clock on Friday, January 18th, this will expire completely and utterly worthless. We have to sell it before expiration. Likewise, weekly options contracts expire at the end of the week in which they are listed. Again, these options can be viewed just depending on when they are listed by expiration. I'll talk in future videos about strike prices and what we know as the Greeks, which is delta. There's some theta that's not listed here. We have all of our call options for this expiration. This is January 25th. Let's take a look at January 18th. Here are our call options. Here are the ask prices and the bid prices. And then we have our put options over here. So we have the ability to purchase calls, and we have the ability to purchase puts. I will make future videos on what calls are specifically and what puts are, how to trade them, and how to take advantage of them. It's real important to remember that these will expire at their expiration. So that is part of the, I guess, the risk that's associated with trading options versus stock. You do get more leverage. You are able to see exponentially higher returns, but you do so at a cost, and that cost is a limited amount of time. Time is actually factored in when pricing options contracts. As you can see, when I mentioned earlier, there's 150 strike price. It's $3.90 ask here for January 11th. If I go out to February 8th, that same $150 call will be $8.05. That's because time is priced into the actual premium that you pay for the option. If we go way out in time to June 19th, 2020, that $150 call is now $23.40. Again, trading options gives us the ability to see much greater returns for the same move that we see in the underlying asset. The use of options will let you participate in the same directional movement of the underlying security, and you won't really have to fork out the same amount of money that you need to purchase that underlying security or commodity unless you really want to. Think about it like renting a car. So if you rent a car, you only use it for a small fraction of time that you would otherwise use a car, and you have the right to use this car by paying less money. Okay, so you can rent a car for far less than you can purchasing a car because you're only going to be using it for a certain period of time. Okay, so the payment of purchasing an option gives you control of the option for a limited period of time, just like renting a car. All right, and just for review, one more time, buying one contract, one options contract, Apple 150 calls, as an example here, will give you control of 100 shares of stock per contract for a set amount of time using only a fraction of the money that you would need to otherwise purchase the underlying stock during the very same period of time. Lastly, I want to show you an example that illustrates the power of options. On January 2nd, Apple closed at a price of $157.91. When investors opened up on January 3rd, or woke up to see the opening price, I should say, that price had fallen by 9%. Investors lost 9% purchasing Apple stock in one single day. However, as charted here, the Apple put option, the 150 put that expired January 11th, appreciated by 690% during the same period of time. Yes, you heard that right. When the Apple stock fell 9%, the put option went up 690%. I'll show you what I'm talking about. Here, on January 2nd, this put closed at $1.12. It went as high the next day as $8.85. If we take $8.85 and we subtract our purchase price of $1.12, that's $7.73. Remember, we buy these in contracts, so what this really means is $773 profit per contract when we only paid $1.12. So let's divide our profit by our purchase price, multiply by 100, and that's a return of 690% overnight on a single day, while other investors lost 9%. So yes, puts appreciate in value when stocks depreciate. Puts go up in value when stocks fall. So as people are selling and they're panicked, you can make an absolute fortune buying put options. I'll teach you exactly how to do that in future videos. I'll talk more about calls, I'll talk more about puts, we'll talk about strategies, much more to come. As I've shown you here, if you play options correctly, they can allow you to see returns on investment greater than you ever thought possible, faster than you ever thought possible. And on the flip side, if you use them incorrectly, options can lead to losses quicker and larger than you ever thought possible. Always remember that no matter what your option is valued at, it will expire totally 100% worthless on its expiration date if it's not executed or sold before the close. There's no exceptions to this and no redos. Stay tuned. Much more to come. I'll show you all about this. I'll show you how you could have seen this move coming. I'll show you how you could have made 690% in a single day on Apple. I'll show you how these opportunities are available every single week, every single month in the stock market. Like, subscribe, stay tuned.